I don't know if you realize this, but you're the new podcast host.
Yeah, right.
You are listening to Digging In Podcast, presented by Rooted Wealth Advisors.
All right, we got Andrew Lee, portfolio manager of Rooted Wealth Advisors, man behind the scenes, doing all the buying, the selling, the trading, the analytics, charting. The guy does it all. Always working hard. So we got him here on the Digging In podcast. Andrew Lee, how we doing? How pumped are you?
I'm super pumped to be back with you. It's been a while since we were on the pod together, so super excited to be back and dig into it a little bit.
Jacqueline was actually happy to hear that we were doing it via Zoom, because I don't think the setup that we had in the conference room was up to par. So, looks like you're grinding there in the new office there in Bloomington. It looks like, huh?
Yep, we got a couple of the boys in the back doing some work, and yeah, just another day at the office here.
I love it, man. No, I appreciate you taking the time to hop on here. I think just a few things that I was thinking about before starting is, depending on when this airs, it's pretty crazy to me to think that just over 2 months ago, there was a period of time market was down, almost 20%. A lot of people were feeling a bit uneasy, a bit unsettled. And, there was just a lot of questions of like, is there a recession, coming? And now as we sit here today, the market's darn near an all-time record high, just in a matter of a couple of months. So, care to elaborate a little bit on kind of what's transpired over the last couple of months?
Yeah, so it's obviously been a pretty crazy ride the last couple of months. The first thing I'd point out is just kind of like what we've talked about internally, and I think even a few videos that we filmed for clients is just a lot of the fear was from really non-material information. So what I mean by that, it was more speculation and more of the unknown. We didn't know what was going to happen with things like tariffs, right? So I think, very easily, if something material would have occurred, we could have continued to slid, but obviously, with the tariffs on, tariffs off, tariffs on, as of now, I believe some of the retaliatory tariffs are going through the court system. So as of now, there's really nothing material going on there. I think today I actually saw a news article saying that Trump has reached an agreement with China. Yet to get details on that. But as of now, I think because there's started to be at least progress towards tariff deals or trade deals, a lot of that fear has went away, and investors really, saw it as a buying opportunity.
So it's interesting that you say, so I think it's good information. I think it's interesting you say that about, this morning I saw the same thing, the deal with China. And frankly, like the deal that I'm reading seems pretty favorable for the United States in comparison to what was said, just a couple months ago. I guess what I'm surprised about is the market's a bit blah, here today with that announcement, along with, in my opinion, fairly favorable or maybe a better term would be stable CPI data. Do you think, I'm just speculating, but do you think that's just because the market has ran up so hard these last couple months that this positive news is fairly baked in? Or, you know, uh, if you're just a retail investor expecting the market to be, soaring today, why isn't it?
Yeah, I would say that I think investors are, since we have run up this much already, I think it was already baked in to some extent. And
Okay.
I think, after the past 2 months, investors are like, okay, well, this could easily reverse, right? So let's just take a minute to breathe here and kind of see where things shake out.
I like that. Ultimately, it's like, okay, it sounds good. Is it going to be good is almost the question at this point in time.
Yep, 100%.
Okay. No, I think that's interesting. And I think that's a reminder to just a lot of, those that are watching and a lot of investors that, hey, like what's happening, right now is not always very relevant. It's what we expect to happen in the coming months, sometimes even longer than that. And that's why, trying to invest and trade on your own can be very difficult. Because by nature we're all emotional. Um so where do you see, like I know the Fed meets next week if I'm not mistaken. Now there's these, everyone's talking about interest rates, right? So what do you think the odds are of them, changing interest rates next week?
I think next week is probably we're gonna hold. Gonna be in a holding pattern still. I think the biggest thing is the jobs data that we have coming up. That's really the last piece of the puzzle for the Fed to kind of take in and assess the situation. Obviously inflation has come down to a little bit above our target. Jobs have remained pretty stable, right? The unemployment rate has, remained pretty level. So from a macro perspective, right, kind of back to any material changes, um, we've been making progress. Really, so again, really the tariff thing is what kind of sunk the market there in April. Um, so I would say we're gonna be holding this next meeting.
Okay, so when you say making progress, just to make sure that I'm understanding, like, so ultimately making progress with regards to stable employment, decreasing inflation, healthy economy. Like is that kind of what we're after, of course, but when we say making progress, like we're achieving those things, is that right?
Yeah, that's right. Yeah, we're getting back to where inflation is stable, right? Stable growth. That's what you want. You don't want inflation at 4 or 5%, right? Because that's not stable over a long period of time.
Hmm.
So we're kind of getting back to that point. Obviously, the fact that we're not seeing unemployment skyrocket is a good thing. That means the economy is still somewhat strong. Um, and then GDP as well. I think the last figures that came out is we're expected to be just call it about even for 2025 on the year. So the fact that we're not seeing a huge drop in that is also a good thing. The Fed's I think has done a pretty good job in not pushing it too far with rates. Right, that could have easily drove the economy into turmoil.
Hmm.
But we're kind of at a point where we're slowly taking the steps we need to kind of get back to a level where we can maintain growth.
Cool. So, I mean, I think, obviously it's still early to say, and I'm not asking you to make any bets, but, in your opinion, the path that we're on, seems to be as good as it gets kind of path, versus where we thought we were a couple months ago.
I think so, yeah. Um, you know, like again, the Fed I think has done a pretty good job. I think
Whoa,
I,
Jerome Powell would love to hear that.
he would. I'm probably one of his only fans right now. Um, and kind of to that, I'm sure a lot of people have seen Trump getting after Powell, right? Saying that these other countries are already taking rates down. There's just a lot of differences, though. Again, at a high level, our economy is way different than some of these other countries, and quite frankly, it's a lot stronger because the U.S. consumer is really the backbone of not only the U.S. but the whole world. So there's a lot of differences there, but I think overall we're on the right path.
So I think that's interesting that, what you just said, because, so monetarily, yeah, we're on the right path. I think what's become a top of mind concern with a lot of the talks is fiscally, from a deficit perspective, we're clearly going in the wrong direction, regardless of, political feelings, this new bill is only going to increase that deficit and spending. So without getting too into it, obviously, like care to elaborate on, maybe the pros and cons of kind of what we're seeing policy wise?
Yeah, so the big beautiful bill, as they call
Yeah.
it. Um, I think if that goes through, right, that's gonna stimulate the economy and the consumer because they're gonna pump more money in, right? Short term, generally speaking, in economics, that's a good thing, right? But long term, it's not sustainable, so it could potentially be detrimental. Um, if it doesn't go through and we actually end up tightening up on fiscal policy, I think it's pretty much the exact opposite. I think the short term, it could have some detrimental effects, right? Because it all goes back to the consumer. Once the consumer quits spending, that's when you really see, uh, GDP start to drag, obviously, the economy as a whole. Long term, I think it could kind of get us back to a point where we can reset and then, go at a nice easy pace as far as growth.
Hmm. Okay. Interesting. I mean, it's good to see both perspectives, on that. Because yeah, I mean, I can understand the argument in the short term, and I can also understand the argument from a long term on both sides of it. But I think just as a regular consumer, right? That's just maybe watching the news, when you hear, 5 trillion, dollars, like those are big numbers. It's big, big spending numbers. And then on top of kind of just an already large deficit, I think that the concern is valid, but once again, you can also see if you just take a step back, you can see some of the pros from it too. So I'll be curious to continue, watching that play out. But I think the issue, right? Correct me if I'm wrong, is like, okay, so monetarily, it's like, wow, like this is a better path than I would have expected just even a couple of years ago. But now fiscally, it's kind of button heads to an extent. So. Just be curious to see how that continues to play out. So, is there any, as we start to look into the summer, right? So like June, first couple weeks of July, notoriously a good period of time for the market in a calendar year. Any specific like asset classes that you and your team are looking at? Like anything specifically just from a general investment perspective that you like going into the summer months?
Um, U.S. equities obviously is always kind of something we're watching, just because generally they're gonna be a high performer. One thing we've been watching in terms of rates is bonds, right, and potentially like mid to longer term bonds. Eventually, if we do see rates to start come down, that's when those are going to be a lot more favorable, right? Extending the duration of those bonds from 1 year out. So those are really the two big ones as far as sectors. I know I mentioned in a couple videos past that we rotated into consumer staples when we initially saw the drop, and then subsequently we rotated a little bit back into tech. Right now we're kind of in a period where we're holding. We got a lot of things that we are watching, but as far as changes, um, we haven't done anything huge yet, I guess I'd say.
Massive. Do you find that it's that it's do you find that it's difficult to find opportunities in a market environment like this? And what I'm referring to is just reiterating that we are nearing record highs again. So those opportunities I assume are harder to find.
I would say so. Yeah, I think it's definitely a little bit tougher. Obviously, like you said, the market's at an all-time high, so it just makes it naturally a little bit harder to justify, buying into a certain position or sector or whatever it is. Also, I would say, there's more retail investors than ever now, right? There's more people investing in the U.S. economy than ever, so that's just naturally going to kind of pump up the prices. So yeah, it's definitely makes it a little tougher.
No, I get you. So, outside of the short term, like if we're looking into like quarter four, where do you like what needs to be happening by the end of the year for the market to be positive, say from now until the end of the year, outside of what we talked about just in the short term, like, looking that much further ahead, is there anything specific that you could identify that you're keeping an eye on?
I think if we get clarity on tariffs, that's number one. I think that's obviously a positive. Number two, I'd say as long as we don't start to see inflation tick back up, which was really the worry with tariffs, right? Is inflation would start ramping back up, which would mean rates would have to stay higher for longer. So if we see inflation stay where it's at, maybe even come down a little bit to the 2% target, um, and then obviously the employment, as long as we see that stay strong, I think we got a clear path forward of positivity.
Wow. No, I think that's good. I think that allows, some of our viewers to, focus on just some of those high level indicators to say, okay, good or bad. No, cool, man. I mean, I appreciate you hopping on, taking the time. Just kind of wanted to peel some layers back to, what can oftentimes feel a bit, overly complicated than maybe it needs to be for a lot of viewers. So, hope we get a chance to do it again, man. And appreciate all you do. And yeah, hope to have you on here soon. Anything else you want to leave our viewers or listeners with when it comes to markets and mustache?
Markets and Mustache. I would just say, as always, if you have any questions at all, call our office. We'll get you in contact with somebody. And even if it's just like you're a little bit worried or want some clarity on things, right? It's better to call instead of kind of stew on that, overnight, and then you're not sleeping, right? So always reach out. We'll be happy to help answer any questions, give some clarity, and yeah, happy to be here. And I hope we do it again soon.
Yeah, amen. Brother, I appreciate you, and we'll chat soon.
See ya.
All right, see you, man.
This was Digging In Podcast, presented by Rooted Wealth Advisors.